Hello, everyone. Today we're going to be taking a look at this book right here, The Little Book of Common Sense Investing by John Bogle. And I'm going to read, let's see if I can find the quote. If I can't find the quote, it doesn't matter. But I'm going to say it if I can't find it. Beating the market is a zero-sum game, and after expenses is a loser's game. That's one of the quotes here. Let's see if I can find it. Um, oh, here we go. This is one of the best quotes in this book. A loser's game. And an investor to seek outpace their peers, a winner's gains is inevitably a loser's losses. A fervous trading activity is surely a winner in costly competition for outperformance. It is only a person who sits in the middle of our financial system. As Warren Buffett wrote, trillions of dollars are managed by Wall Street, changing high fees are usually exchanged by managers who outsize profits, not the clients. In the casino, the house always wins. The house racing, the track always wins. The Powerball lottery, the state always wins. Investing is no different. In the game of investing, financial corporations always win. The investors, as a group, lose. After you deduct the cost of investing, beating the market is a loser's game. But I cannot find. Oh, here we go. Before deduction of cost of investing, beating the market is a zero sum game. So basically, if you added those quotes together, it's trying to beat the market is a zero sum game. After expenses is a loser's game. And this book is fantastic. The first chapter of this book, what is it? I cannot find it, but it's the first chapter is amazing. Oh, here we go. A parable. This is probably one of the best chapters I've ever read. When it comes to John Bogle content, this is fantastic. Um, there is this is probably one of the best chapters. I don't know if you can see it. Okay, well, it's fine. The parable, the Rockgott's family. I think that's how you pronounce it. And it's a story told by Warren Buffett, and it's fantastic. I'm actually gonna read the story because it's that good. It's just 3 pages long. I'm gonna read the introduction of the story and the story together. I'm just gonna read chapter 1. Before you think about index funds and their basic form, mutual funds are simply shares substantial to all stocks in the U.S. stock market and hold them forever. You must understand the stock market actually works. Perhaps a folksy parable, the version of a story told by Warren Buffett, chairman of Berkshire Hathaway Inc. The firm's 2005 annual report will clearly clarify the foolishness and the counterproductivity of our vast and complex financial system. And this is the story. Okay, so once upon a time, there was a family named the Gottrocks. They grew over generations, over thousands of brothers, sisters, aunts, cousins. They owned 100% of all the stocks in the U.S. stock market. Each year, they reaped the rewards of investing, the earnings of those thousands of corporations generated by the dividends that distributed. That's also it says at the bottom of the book, it says they also owned initial public offerings. I don't recommend buying them, but if it was in the index fund, that's what they bought. Each family grew wealthier as they compounded over the decades. Enormous wealth, the Gottrocks family played a winner's game. But after a while, a few of the helpers arrived on the scene to persuade some smart, quote unquote smart, Gottrocks or cousins to have a large share of their relatives. The helpers convinced the cousins to sell some of their shares of the companies to other family members to buy shares of other companies for them in return. The helpers handled the transactions as brokers and received compensations for their services. The ownership among the family members. To their surprise, however, the family wealth began to grow at a slower pace. Why? Because some of the investment return is now considered by the helpers the family share of the generous pie of the U.S. but that the U.S. industry bakes each year. The dividends of those paid, all the earnings reinvested into the business, 100% of the outset starts to decline simply because of some of the return is now consumed by the helpers. What matters worse, in addition, is the taxes the family now pay on dividends, and some of the members are paying capital gains taxes. Their stock swip back and forth generates capital gain taxes, furiously diminishing the family's total wealth. So that's basically the helpers basically buying and selling the stocks. I don't know. I'm explaining the story way too much. I probably should continue reading. Smart cousins simply realized their plan to actually diminish the rate of growth in the family's wealth. They recognized the fortitude to the family stock picking as a failure and concluded they have professional assistants. They better pick the right stocks for themselves. So they hired they hire stock picking experts, more helpers, a great advantage. These money managers charge fees for their services. So the family appraises the wealth a year later, finds out the share of the pie has diminished even further. To make matters still worse, the managers feel compelled to keep their trading by the family stocks at frivolously levels of activity, not only increasing the broker's commissions paid to the first set of helpers, but running up the tax bill as well. Now the family earlier 100% of the shares and dividends pie is furiously diminished. We have failed to pick good stocks ourselves, and it didn't work. We have also failed to pick managers we could do, said the smart cousins. What shall we do? Undermined by the two previous failures, they decided to have new helpers. They retained the best consonants and financial planners to help them find the right. The consonants say, just pay us a fee for our services. The new helpers, the cousins, and well then, these costs added up. The family's share of the pie tumbles once again. To get rid of the help all your helpers, then your family will reap 100% of the pie in corporate America bakes for you. Alarmed at last, the family sits down together and takes events at the take stock events and transpired since they began to outsmart the others. How is it, they asked, that our original 100% share of the pie, made up of all those dividends and earnings, dwindled down to just 60%? The widest old stage uncle softly responded, all that money you've paid out to those helpers and unnecessary taxes you are paying goes directly to our family total earnings and dividends. Go back to square one and do so immediately. Get rid of your brokers, get rid of your money managers, get rid of your consultants. Then your family will reap 100% of however large corporate America bakes for you year after year. They followed the uncle's wise advice to their passive but productive strategy, holding all the stocks of corporate America and standing pat. That is exactly what an index fund does. And the Gottfried's family lived happily ever after. And it talks about, it talks about successful investing. If you're paying somebody to invest for you, especially if you want to have the fair return in the stock market, like it says in this book, the only way to guarantee a fair shake in the stock market, your fair share of stock market returns, I mean, whatever. I'm reading it wrong. Basically, the book is basically saying why should you pay people who are going to underperform the stock market, especially 90% of money managers. It actually has a chart where 90% of people underperform the stock market over a course of 40 years. And I do have a valuation formula for how to beat the stock market, but to be honest with you, I'm not going to use it just because I'd rather just own the stock market. It's probably just easier anyway. And it generates a lot of capital gains taxes, my formula. So in a lot of ways, I don't want to do that. So that's why I like this book. It shows you that even if you're wanting to just do a single stocks, and single stocks again, it doesn't say not to do single stocks, but a lot of ways index funds are the best and easiest way to invest. Cheapest, best. They're slow. They're the slowest in terms of like the beginning. They're slow, but once you add up all the costs to investing over a course of your lifetime, you are going to make millions of dollars more, or whatever. You'll make whatever more. You know, in the case of a few of my family members, millions. In case of some of my family members who are actually invested in index funds, not as they already have all the total return on the stock market. And then basically the ideal is to pay as little fees as possible, little taxes as possible. And it also talks about retirement accounts at the end of the book. I feel kind of sad that they didn't talk about retirement accounts too much. They should have mentioned them a little bit more. But that's what the other book, Stop Being a Broke Loser, is about. Yeah, it's just this book is fantastic though. John Bogle, he died sadly, rest in peace, and this is his last book he wrote. And Warren Buffett is in this book a lot. And let's see here. 100 years from today, this is a quote. 100 years from today, historians will note on the two investors of this era, Warren Buffett and John Bogle. Two books to note: Buffett's Bible, Ben Graham's Intelligent Investor, and anything written by John Bogle. In the word of investment foxes, Jack remains a servant hedgehog. The little book of common sense investing, updated here, will provide timeless and thoughtful art- articles of Bogle's one big ideal: how investors can get a fair share of market returns. And I think that was a fantastic quote for this book. And the fact that he's dead is just sad. I am actually planning on getting another book from John Bogle's successor, Jack. I forgot his name, Jack somebody. And when I get that book, I'm gonna be so excited because it's an updated version of this book, and it is so good. I can't wait to read it. It's gonna be there's gonna be the ideals are gonna be similar in that book. But I did read a little bit more about it, and there's a lot of new ideals in that book. So yeah, I am going to I'm gonna enjoy reading some of these books that I'm getting, and I haven't finished all of John Bogle's books, but I am going to eventually read all of John Bogle's books. But I think that if there's the one investment book you should read, this is the number one book I've read so far. The Intelligent Investor, maybe not. Maybe the Intelligent Investor is like third. Maybe John Bogle on Investing is third, for second. So John Bogle on Investing I recommend is second. Little Book of Common Sense Investing first. The Intelligent Investor third, and Bogle on Mutual Funds fourth. Those are like the big investment ones I have read. And I recommend all four of them, but if you're going to get one out of all of them, just get the Little Book of Common Sense Investing. You don't really have to go any more detail on that. You don't really have to read anything else. But I love reading because it keeps me focused on my investing strategy in the stock market. So for me, if you want like all the evidence in the world to support your investing thesis, although it does seem like I'm in an echo chamber because you're reading from just the one guy, but he's so smart, listening to him and hearing his reasoning behind it, hearing the reasoning behind his investing philosophy, I don't think that you can really argue against John Bogle. It's very hard to argue against John Bogle. There's a few people in there in the book where they're arguing about against John Bogle, but at some point, like John Bogle's right. After taxes and fees, index funds, while they might perform lower in terms of short-term returns, over the long period of time, you will win. You are a loser short term, but you are in long term, you're winning. And so you want to focus on a long-term perspective over a short-term perspective. And that's what makes this book so good. I don't know how to explain it. It's like, and obviously I disagree with one thing in this book. He does say that his advice of his 1993 book, Bogle on mutual funds, not to own international index funds. I disagree with that. I think you should not just own international stocks, international index funds. I think you should be buying world index funds. Because personally, you don't know what index fund is going to do better, so why not own an index fund that owns both of them? And whatever performs better, you own more percentage of. Now, you're always going to underperform one and you're going to outperform the other one. But eventually, over time, you should be relatively better off than someone who picked this one or the other. You should probably be okay. No matter what happens, if you pick this international fund or this a U.S. fund, you should be fine. But I picked both. I have an index fund called VT. It does both of them at the same time. That's one thing I disagree with John Bogle in this book. I think he doesn't really talk about the international side of investing. And I know he doesn't like the taxes involved. He doesn't like the fees involved. But if you buy a world index fund, you're paying U.S. taxes. And if you put in a Roth, the U.S. government's going to pay those taxes for you. So, again, like, that's the thing. Like, I don't think John Bogle really was talking about taxes when it comes to. He was just criticizing it for the U.S. dollar is more valuable. Well, like, what happens to the U.S. dollar drops in value compared to other currencies. You know what I mean? And so, in a lot of ways, I disagree with John Bogle because you never know if the U.S. dollar is going to go up or down. And so for me, I buy things, even though it's denominated in U.S. dollars, there's currencies in that stock, that VT ETF. It's not really a stock, it's an ETF, but it has a bunch of stocks, 9,000 stocks inside of it. And it has different currencies in it. So if the US dollar goes down, well, I can denominate into a different currency. And that's the beauty of being a global investor instead of a US based investors only focus on one country. I think you should focus on the world. But that's just my opinion. But John Bogle, despite the criticism of that I have against John Bogle with that, he's right. Everything in this book is right, despite he's absolutely correct. Pretty much on international stocks, he's been right for the last 30 years. But will he be right? Well, he's dead, but will he be right in the next 30 years? I don't know, right? And so that's going to be a question that no one knows the answer to. Anyway, highly recommend this book. Best, I'm gonna say, I'm actually gonna put the title of this book, but Jack Bogle's best book by far. I should read another. He has two more books I want to read from him. I'm thinking about reading, and I will do reviews on them when I find the best chapters in those books. I will review those chapters. Anyway, you are someone and I'm someone else, and I hope you enjoyed this book review. Yeah.